Oil prices have been volatile over the last few weeks, and that's been driven by changes in supply-demand fundamentals looking forward. At the end of November, OPEC announced a cut in production that was largely expected by the market, but anyway, we still saw a lot of volatility as a result of that, with prices trading as much as $10 higher. Since then, we've seen prices increase further still, with trading on Monday seeing oil prices push up to a fresh 18-month high, and that was linked to global producers led by Russia, who've also come to the fray and said they're going to cut production as well, which has seen the overall amount of production cut expected for the start of 2017 to be 1.8 million barrels, which could potentially see the system in terms of global oil supply demand turn into a deficit. We're potentially going to see oil prices increase going forward. In terms of gas and power specifically over the near term, temperature forecasts are going to continue to be key in driving prices. Although we've enjoyed a relatively mild December, temperatures are expected to decrease later in the month, moving towards the Christmas period, which could see demand increase for both gas and power. In terms of the nuclear situation in France, there have been some developments over the last week which potentially made things look a bit more optimistic over the short term. So EDF announced that 3 of the nuclear reactors in France that were due back on the 1st of January, they've actually brought forward that return date to the 21st of December, and that's potentially going to see supply margins increase in France, which in turn would result in lower export demand from the UK to France. So we start off looking at oil prices. As I've mentioned, we've seen them push up to fresh 18-month highs, and again that's been spurred by changes in the supply-demand fundamentals. That much higher oil price has prompted some volatility on gas and power, and at the start of this week we saw oil price trade about 5% higher on Monday, and we also saw UK gas and power trade about 3% higher as a result on that same Monday. In terms of seasonal gas and power prices looking forward, we have seen over the last few weeks that they've been trending lower. However, at the end of last week, we saw them bounce quite strongly off a medium-term trend line, which is, for me, indicated that we're potentially seeing the majority of the losses over the short term, and moving forward, there's potentially more gains on the horizon. In terms of the day-ahead market for both gas and power, it continues to be driven largely by changing supply-demand fundamentals. As we've mentioned, temperature forecasts have been very sporadic over the last few weeks, with temperatures in November at record highs, then at record lows, and then throughout December so far we've seen a relatively mild month. But as I mentioned, we are expecting to see temperatures dip towards the end of the month, and that's playing havoc with the day-ahead market, which continues to be volatile. So looking for customers who are looking to place a fixed price contract, this recent downturn in prices that we've seen over the last few weeks is very much an opportunity for you to enter the market and fix a fixed price contract. In terms of contract duration, at least 12 months, and if you want to look fixed further than that, the main thing you need to think about is your attitude to risk. Whilst we've said we've seen prices decrease, they have bounced higher off a medium-term trend line, which indicates there's possibly more upside over the short term. However, we are speculating that there's possibly going to be some downside in Q1, but it's very demand related. If we get a relatively mild start to Q1, the possibility is that we're going to see prices decrease in Q1 for the forward seasons, which would mean leaving a fixed price contract for years 2 and 3 till beyond that period might be desirable. But Q1 is a very risky period and prices could prove to be very volatile. So if you're quite risk averse, I'd recommend fixing for a longer duration before Q1. In terms of flexible contracts, again, the same message. We've seen prices dip over the last few weeks, which represents a buying opportunity. And as we've said, they've found support at a trend line, and over the short term, we're expecting prices to increase. So at the minute, it's a case of increasing the hedge if you've got volume exposure you wanted to cover. And if you're already sitting on a relatively high hedge, it would be a wait and see approach until Q1, where there potentially might be some more downside to come.